In this week's video, we'll review a wide range of data to help us answer the question, what do these 6 studies tell us about the outlook for stocks? Starting with this short takes post here, left side of the screen that appeared on April 14th that had this table here where my cursor is. Observable evidence told us to keep an open mind about much better than expected outcomes, especially from a longer term perspective in the stock market. As we review all of the data, including the 6 studies in this week's video, we should be asking ourselves, does the present day data align with or contradict the data that we've been covering in these videos since mid-April? Study number 1. The upper portion of the screen shows us the percentage of S&P 500 stocks greater than their 200-day exponential moving average. We only have data going back to 1999, thus we are looking at all the data. In 2020, we had a very rare oversold condition seen here and here, and then we rallied all the way back to the green line. Only happened 2 previous times, after the major stock market low in 2002 and after the major stock market low in 2009. Therefore, it might be helpful to ask and answer, how did the stock market perform walking forward in the 2 historical cases? May 30th, 2003 and July 31st, 2009 are similar to what took place on August 31st of 2020. In the 2 previous cases, stocks were higher 4 months later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. In the 2003 case, the market was higher by 32% 3 years out. 2009 case, the market, S&P 500, was 40% higher 3 years from the date of the signal. Just as this table helped us keep an open mind about better than expected outcomes way back in April, we all know there was a ton of uncertainty back in April. There's still a ton of uncertainty in the present day. This study helps us keep an open mind about a wide range of outcomes, even much better than expected outcomes. In the 2 previous cases, the maximum S&P 500 drawdown from the date of the signal was relatively muted. Study number 2. This is the RYDEX bull-bear ratio. We have data going back to 1998. If we use rate of change, we have data going back to 1999. This is the 144-day rate of change. Why 144 days? We all know the answer. It's been 144 trading days since the low was made in March of 2020. That's as of the date of this chart, which is October 14th of 2020. Only 2 previous times in the last 22 years have we seen a move like this. The rate of change going from this rare level up here where the green line is and then dropping down to the blue line. This speaks to a high degree of fear, and this speaks to declining fear. How did stocks perform in the 2 previous cases? From a longer-term perspective, quite well. Both cases, stocks were higher 2 months later, 3 months later, 6 months later, all the way out to 4 years later. Average gain 3 years from the date of the signal, 34%. The left side of the table helps us maintain realistic expectations about 100% normal and to be expected stock market volatility that occurs even within the context of the strongest bullish trends. How about maximum drawdowns? Once again, relatively muted in the 2 historical cases. However, in the real world, even a 2 to 3% drop is not a lot of fun in the stock market. Study number 3. Another breadth indicator. We're looking at the percent of NASDAQ stocks above their 200-day simple moving average. Similar concepts here. We moved from a very rare oversold level in 2020 and clawed our way back to the upper blue horizontal line. Using all of the data that we have, there's only been 3 previous cases in 03, 09, and 2012. And if you know your market history, you know from a longer term perspective, those were excellent times to have capital in harm's way from a probability perspective. All three cases, stocks were higher 6 months later, all the way out to 5 years later. To get to the right side of the table, investors did have to endure some 100% normal and to be expected volatility. Maximum drawdowns in these historical cases, a little bit more severe. The median drawdown was 4.37%, average drawdown pushing 4%. Study number 4. Similar concepts. Now we're looking at NASDAQ 100 stocks greater than their 150-day simple moving average. Once again, we have data going back to 2002. The rare oversold look early in calendar year 2020, claw our way back to the upper blue horizontal line similar to this point here, and this point here. Only happened 3 previous times dating back to 2002, and from a longer-term perspective, good things happened in the stock market. 1 year later, case 1, 11% higher, case 2, 13% higher, and case 3, almost 17% higher in the S&P 500 index. To make it to the right side of the table, investors had to endure normal volatility. There's no free lunch in the stock market, and to get to the right side of that green table, the drawdowns were somewhere between 2 and 4%. Study number 5. And as we walk through these studies, we have to keep in mind, technical analysis cannot predict the future. We have to use our own intelligence to try to determine what the past actions of some traders may say about the future actions of other traders. And in the 4 historical cases, when we had a similar move relative to the past action of some traders, this move here is similar to this move here. In the 2016 case, this point here is similar to this point here. The S&P 500 was 15% higher 1 year later, 31% higher 2 years later, 36% higher 3 years later, and 51% higher 4 years later. Simply helping us assess probabilities relative to what the past action of some traders may tell us about the future action of other traders. The key word in the previous statements, may. May is significantly different from the term certainty. Once again, it's very, very easy to watch these videos and see these green tables and somehow expect the stock market to go up every day. Even in the historical cases where really, really good things happened, from a longer-term perspective, investors had to endure some gut-wrenching givebacks to make it to the right side of the table. For the most part, in anything in life, having realistic expectations helps with execution. It also helps with day-to-day happiness. You can pause your video player here. This is a breadth indicator. Description of the indicator here. Here's the low in 2019. This is somewhat of a multiple breadth thrust look here. Later in 2019, we get somewhat of a follow-through look, and the stock market on the bottom of the screen rallies. Anecdotally, you can make an argument we have a similar setup in 2020. This look here, similar to this look here, and this look here, this is dated October 14th of 2020, is similar to this look here. This concept here is very, very similar to this study here done by LPL Research. Something that just happened in the present day, from oversold to overbought quickly. After that, typically good things happen for a long period of time. 93% of the historical cases, the stock market was higher 12 months later. The average gain was 18%, the median gain 18.8%. Hard to argue with this tweet from Ryan Dietrich. It too is based on observable evidence and has nothing to do with an opinion and really has nothing to do with forecasting. We can see all of this, measure it, and put it in a model. Top portion of your screen is the NYSE Advanced Decline line. As of October 16th at 9:42 a.m. Eastern Time, the S&P 500 had not exceeded this September high here. This is a bullish breadth divergence. This is a higher high relative to these highs here. Hard to make an argument that this leans bearish. Similar situation here, NYSE new highs minus new lows. Here's the plunge earlier in 2020. This really doesn't predict anything. It's more of a coincident indicator. Look at the drop here early in this decline. Right here, stock market's here, then bad things continue to happen. The present day, instead of making a series of lower lows with a sharp decline, we're making a series of higher highs. Did have a blip here, but it's not unusual to have blips within the context of a bullish trend. Once again, the stock market has not exceeded this September high. The breadth indicator has exceeded that high. Fair question might be, Chris and Kathy, how does that trend strength model look? The long-term score and the shorter-term score. You can basically answer the question by looking at the moving averages. They both look very, very constructive. Concerns would increase if we shifted from a look like this to a hot knife through butter look like this, and if the slope of this moving average started to roll over as it did over here, and if we started getting bearish moving average crossovers. All of that may happen, but it hasn't happened yet. I'm covering this chart for a long time now about the VIX. Don't really see anything particularly alarming on Friday, October 16th at 12:26 p.m. Eastern Time. Here's another bullish divergence here, RSI for KBE banks. This is a higher high relative to this high. Price right now, this close here is lower than this close here. This also looks like somewhat of a failed bearish breakdown. Now this looks like a bullish breakout short term relative to the downward sloping trend line from the June high, and you can make an argument on Friday this looks like somewhat of a retest. This price action tells us that we are still in indecisive mode. You want to see another example of that indecisive mode? Just box this little area here on bonds versus stocks. If you remember, the stock market rallied nicely in the month of August. See this bearish breakdown here? If we get something similar, we'll learn something. If we break this third trend line from a fan principle, we'll learn something. Not making any predictions about the look of this chart. We'll see what happens as we walk forward. Here's another chart that leans bullish. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. Small caps IWM relative to TLT long-term treasury bonds has now exceeded the June high on the ratio. It has exceeded this hesitation area here on the original plunge and is now pushing higher. It would be nice to see a higher high here next. Similar concepts here. Intraday on Friday, October 16th, JNK relative to IEF. Right now, above the June high and above this consolidation box. So weekly chart of QQQTLT, 1:46 Eastern Time on Friday, October 16th. We are still holding above the area that once acted as resistance, and may now act as support. Once again, we'd prefer to see a higher high here. That may happen. Hasn't happened yet. Still in an indecisive area here, but also telling us to be open to bullish outcomes. A chart like this also tells us to be open to underperformance in gold walking forward. We'll see how it plays out. Once again, hard to make an argument this has a bearish look. This is growth stocks, SCHG as in George, relative to TLT. Here is the high in Q1 of 2020. Here's the June high way down here. Here's the September high. We're above all of those highs, and we recently made a new high. Everything that we just said about the previous chart, for the most part, applies to semiconductors relative to bonds. So weekly chart of the VIX, 29-week rate of change. It's been roughly 29 weeks since the major low in March of this year. Really no reason to do a study here. We've only seen something like this on a rate of change one other time in the entire history of the VIX. That was after the major low in 2009. And if you know your stock market history, good things happened walking forward from about mid-year to Q3, Q4 of 2009 from a longer-term perspective. The message from this chart here is very, very similar to the message from the credit markets in this tweet from the St. Louis Fed. Also hard to argue that the tweet on the right, that is somehow going to hold back the economy or be bad for economic growth. Low interest rates tend to stimulate the economy. Did we forget about study number 6? No, we did not. Daily chart of the S&P 500 index as of October 15, 2020. Once again, looking at the 144 trading day rate of change. We have a chart going back 70 years, all the way back to 1950. Only 3 times in the last 70 years have we seen a move like this. If you know your stock market history, you would know that this is after a major low in 1975. This is after a major secular low in 1982. And this is after a major low that was put in March of 2009. These 3 dates here are similar to October 12th of 2020, something that just happened in the rearview mirror. What can we learn about longer-term stock market probabilities based on the 3 previous cases? And do the results align with or contradict everything that we've been covering since April 6th? The answer? There's a lot of green in this table. From a long-term perspective, it's hard to make the argument that the answer is anything other than aligns with. How does all of this help us? Clients and regular viewers know that we do not trade historical studies. We trade the chart in front of us. Studies help us assess the probability of good things happening relative to the probability of bad things happening, which is significantly different from predicting or forecasting. Human nature being what it is always easier to respect the wildly bearish case. It is much more difficult to understand the wildly bullish case. These 6 studies help us with the concept on the screen. And in order to properly trade the chart in front of us, we must remain open to all outcomes, from wildly bullish to wildly bearish. And that is a fractal statement. That applies to next week, next month, next quarter, and the next decade. If we truly respect a wide range of market outcomes, it's very, very easy to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.